Everybody sees a pretty much, 100% chance of a pause. Assuming that happens, what else are you looking at when it comes to this Fed meeting?
Yeah, so I think I'm looking for hints in the statement that they're moving toward a stance that even if they hold rates steady, policy will continue to get more restrictive over time if inflation is falling. So there's a word in the statement, additional, judging what additional policy tightening might be needed. If you just take out the word additional and say what policy tightening may be needed, that is a step in that direction. So are there hints in the statement? How many of the dots in 2023 come down? Is it a full 25 basis point lower median, or is it directionally lower but not quite a full 25 basis points? I think just the direction matters. And I think at the end of the day, when we go into the Q&A with Chair Powell, I think he's going to struggle to keep a hawkish tone, even as they want to keep the door open to hike further if needed.
So right now you're focused on the dot plots, but there's so many uncertain things going on right now that I would assume that the Fed is paying pretty close attention to. There's obviously labor negotiations with the UAW workers. There's rising oil prices. There's a potential for the U.S. credit rating to be downgraded again. Are the dot plots that we're going to see tomorrow, do you think they reflect a long-term view, or is it subject to change based on some of these big, at least U.S. factors?
No, I think, look, focus on 2023 and what happens with those forecast changes, I really think is most important here. The Fed is going to have to almost double its growth forecast. And so even though they need to greatly bring down their inflation forecast because inflation is coming in well lower than their expectation, some members might be hesitant to do a full mark to market just because if growth is going to be that strong, you're going to be a little skeptical that the pace of deceleration and inflation is going to continue. So I think that's going to be a struggle for them as they balance that. You mentioned energy prices. That's actually a blessing in disguise for the Fed. When energy prices are rising, they act as a tax on households, and you get a drag on real income and consumption. And for a Fed that has been trying to slow the economy more with a frustratingly resilient consumer, that could actually be a blessing in disguise.
All right. So I know you're also looking for an economist, looking at a lot of the wording of what the Fed's going to say. You're also looking at their July statement. So there's one part you're focused on in that July FOMC statement. It says in part, tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risk. You say removing the word highly out of that sentence, just that one, omission could have a big market impact. Please explain.
It could. So the word highly, the word closely, these are things that are really like sort of heightened alert for the Fed. And so when they get more comfortable with something, they tend to take those words out. So I'm going to be focused on, do they remove the word highly? Also in the statement, do they not just say that inflation is elevated? Do they say inflation has slowed but remains elevated? On labor, do they not just say it's robust? Do they say job gains have slowed in recent months but remain robust? These are tiny little tweaks that shouldn't be taken lightly, and they would be baby steps towards stopping the hiking cycle. We do believe that the Fed is done here. They just don't know it yet.
Okay, well, you're actually answering part of the question I was going to ask you. Have we seen the last rate hike, and are you expecting cuts next year? I'm sure your clients are asking you about your expectations. If we see cuts next year, how many and when do they start?
So we do think that we'll see 4 rate cuts next year. They start in March at a quarterly pace. And that's because we think that the Fed will want to ensure that inflation continues to fall. So they can't let up on how restrictive they are. But as inflation is falling, you maintain the same level of restrictiveness if you are following inflation lower with the policy rate. And so that's the environment that we think we'll be in next year. As you know, we're the earliest on the street calling for a soft landing. We started calling for that in February of 2022. And we do think that the Fed is going to have to keep pressure on the economy here to get it to slow enough. But no recession. That would be a different story where they're cutting rates very aggressively next year.